A lot of people get confused between GDP growth and stock. They think if a country does well, I think China's been doing well for years, but the stock market hasn't gone anywhere.
Today I have a very special guest with me, someone who has over 30 years of experience managing people's money in the stock market, and someone who has also had a great run in the last 1 year, specifically in some of his funds that he manages. I'm talking about Manish Gunwani of Bandhan AMC. From this point on, for small caps, do you feel that there's a bit of valuation concern?
So a good small cap fund, I think, has enough opportunity to create massive amount of alpha.
Now the size is what? About over 20,000 crores of the
small cap
fund?
almost 28 to 30,000
Oh, it's
crores.
reached 30,000 crores.
Yeah.
Wow. HUL has reported a 5% volume growth, right? Infosys barely 2-3%. So why would I, as an investor, want to invest in a company that's doing 5-6% growth when there are a lot of small caps that are sort of on a high growth path?
I can see some case for large cap. If the slows down for a year or two, there might be a phase of large cap outperformance.
If you had to take a wild guess over the next 1 year, which will be the sector you think of the moment?
I think India finance.
Hey guys, welcome to the Money Mindset. Today I have a very special guest with me, someone who has over 30 years of experience managing people's money in the stock market, and someone who has also had a great run in the last 1 year, specifically in some of his funds that he manages. I'm talking about Manish Gunwani of Bandhan AMC. Manish, thank you so much for being on the show.
Thanks, Sonia, for having me. This is a really special one because my family is a big fan of yours. They follow you on Insta. And more than me, they are super excited that I'm doing this podcast.
Okay, that's interesting. So you were telling me that your daughters, you have two daughters in age group of 18 to 25. So
23, yeah.
18 to 23, okay. One is 18, one is 23.
Yeah.
Okay, interesting. So you're like, they're Gen Z, right? Both of them.
I actually don't know. I get confused between millennials and Gen Zs and all that. But yeah, probably Gen Z, right?
So they're going to be very excited to see you on the
Yes.
podcast. We're going to make sure, okay, shout out to your daughters. What are their names?
Adya and Arna.
Adya and
Arna.
Arna. Okay, shout out to Adya and Arna, who are both studying. One is studying, one is working, I think, right? Okay, so shout out to them. And your dad's pretty cool. I mean, I know you don't think he's cool enough, but
And I should thank you for breaking the myth about diamonds being a girl's best friend, right? I mean, they've turned out to be horrible investments. A woman won't listen to that from a man. So it's good that you highlighted that, right?
absolutely. I never, except maybe my engagement ring, I never ever bought diamonds. And I used to always wonder, why do women spend their money on something that's, literally a marketing gimmick, right? And now after lab-grown diamonds came in, and then that whole scarcity premium myth was busted.
I think you had foresight because 10, 15 years back when we didn't see lab-grown diamonds trend, we thought gold and silver diamonds are the same, right? Scarcity premiums are in both. But yeah, one turned out to be a great investment and one turned out to be a dud, actually.
But
At big cost to us.
big cost, I know. But I don't know about you, but in my generation, a lot of people don't buy diamonds. A lot of women
last
don't.
10 years, I think the allure has gone down.
Of course, absolutely. I mean, I think women are becoming smarter now. They're becoming more aware. Even if you look at the data, right? Mutual fund investors also, women investors have increased. So I'm happy. Do your daughters invest?
The elder one just started. She's in US, so she does a lot of these ETFs. Gold ETF, MSCI World ETF. She's not gone on to single stocks yet.
Okay, interesting. Yes. So both of them are in the US.
Yes.
Okay. For me, I think I have known you for maybe over 15 years now. Your whole journey is what I watch from Nippon, now Bandhan. And how has it been for you? I mean, it's been a stellar performance when you look at it from the outside. But how has your own journey been?
Spectacular. Actually, I thank God every day for this fantastic journey because not too many people notice this. But when I started in ICICI Pro, first I did PMS for 2 years. Then I managed the biggest or one of the biggest large cap funds, ICICI Blue Chip. When I went to Nippon, I managed one of the biggest mid cap funds, Nippon Growth. And when I came here, I've done small caps. So not only has it been okay in performance, but it's been very interesting because I've done different market caps across 15 years.
Wow, and that must have been a really, interesting journey for you, a good learning curve as well.
Super.
Yeah, especially now, right? I mean, you're in the limelight because of the the small cap fund performance. And I must tell you that in COVID is when I invested in a small cap fund, and the returns have been spectacular since then. And your own Bandhan small cap fund, I think, has given 27% returns in the last 3 years.
Yeah, I don't remember the number, but yes, could be.
So I want to understand from you, A, does the small cap fund performance continue with this kind of, ferocious growth? And B, what is the investment philosophy? I mean, how does one understand how to sort of navigate the small cap landscape?
So the first ties in with the second. I'll come to what kind of return expectations people should have. So, the small cap fund is run with a very different mindset from other funds. Even the funds that we manage, like ICICI Blue Chip or Nippon Growth or Bandhan Large Mid, These we've run with a very benchmark aware kind of style. We have a certain target alpha in mind roughly, and we take enough risk to achieve that alpha. But small cap fund, we run with a more aggressive mindset in the sense that we're more absolute return. We're not very benchmark centric. And the thesis for this, the underlying philosophy is this, that see today and maybe for last 2 3 years, generally we've been around a fair value market. It's not been like a COVID distress or 2007 bubble, right? So we generally feel, first of all, key headlines indices will do 10-12% CAGR on a 5-year basis. Um, the way we deploy money in small cap fund, see, every day we get, let's say, 100 rupees. What we're very particular about is to say that we should deploy this only in stocks where we see very high probability of them doubling in 3 to 4 years. If we don't get that, as much as possible, you sit on cash. So last year, there was a point in time when we went to 16% cash, which we would never do in a benchmark centric fund, right? 16% is a big cash level. So the point here is this, that look, if a stock doubles in 3 to 4 years, that's roughly 18 to 24% annual compounded return. Now, out of every 10 stocks we buy, it will hopefully, our strike rate should be 5, 6, 7 maybe, right? So the blended portfolio return would be slightly less than 18 to 24%. There might be few stocks which may actually do more than what we think. So the idea is, even if our strike rate is 5, 6 or 7, we should end up with a high teen return portfolio. And if the main headline is doing 10-12%, that is good alpha to have. Now, at the back of the mind, there is a role model called Peter Lynch, right, who did 30% CAGR for 12 years with Magellan Fund. And why I correlate that is, the number of stocks in Magellan Fund when he quit was 900.
In a single fund.
In a single fund. So our style is also similar. We have 225 stocks or 250 stocks at this point of time. So high teen is what we think is base case. But at the back of the mind, the aspiration is to mimic Peter Lynch.
Wow. Because it's interesting, right? I mean, we talked about your fund from inception till now, from COVID to now. And from COVID to now, anything will look very good.
That's a wrong base to look at.
It's
right?
a wrong
That's
base.
a wrong base.
So, in terms of rolling returns, what is it that a new investor who perhaps gets into
as
the
I
fund?
said, our what should I say? Our normal probability distribution, the mean plus or minus 1 sigma, is technical language, but high probability we should be high teens. Again, this is with all standard disclaimers about, obviously, it depends on the headline indices themselves doing double digit. But the aspiration is quite aggressive. As I said, we take fairly big calls on cash, on stocks which are very unpopular. So, see, the point I was making is, in a lot of funds, we worry about what's there in the benchmark, right? This is one of the few funds, I think, where we are just saying that if a stock growing at 10% is 40p, then I don't care whether it's in the benchmark or not, I will not own it, right? So we're waiting for those right balls to come, the full tosses to hit them for a 6. Otherwise, we'll leave them outside the off-stump kinds.
But from this point on, in general for small caps, do you feel that there's a bit of valuation concern, or do you think that there can still be a big rally in the small cap space?
I'm not so defensive on the... Okay, so let me nuance this a bit, right? First of all, I think small cap is a space where small cap index and a good small cap fund are two very different things. Right? Unlike maybe large and mid spaces where your ability to create alpha is a bit limited because number of stocks are limited and they're well covered, price discovery is more efficient. So a good small cap fund, I think, has enough opportunity to create a massive amount of alpha actually. Because see, what can an institution invest in? Let's say we assume a cut of 3,000, 4,000 crore market cap. Below that, for MF, it becomes difficult nowadays. There's still 700, 800 stocks to look at, right? Each segment goes through their own cycle. A lot of them come to distress valuation. A lot of them have high growth. A lot of them have great management. So ultimately, a stock works because of three things. Either there's a great management or a great business model or great valuation, right? You can get a lot of these extremities in those 800 stocks, let's say, with enough juice for you to deploy a decent amount of money. Now, the only challenge is Unlike large and mid, where you can deploy, let's say, hundreds of crores very quickly in one or two stocks. Here you will have to cover a lot of stocks to deploy the same amount of money. It's harder work actually. But if a team can execute, I think there's a lot of opportunity to create um, decent alpha over headline indices.
Hmm. In fact, talking about headline indices, I think in one of your recent podcasts, you spoke about how the large cap companies in India today are just routine business as usual. They're not doing any major innovation, which is a fact, right? I mean, you also took references of, say, companies like Nvidia and that are doing major innovation globally, but you're not seeing that as much in India.
Look, I don't want to be disrespectful of large
Fair,
caps.
fair.
What I'm trying to say is a lot of people pan these IT services company for not doing innovation. I think it's not fair because on hindsight, anyone can be wise, right? Like today, if you want to criticize or raise an issue, you should raise why Maruti is not investing in battery chemicals, right? Do it now. After 10 years, when AI has come, on hindsight, you go and criticize companies because let's say 10 years back, if any of these IT services companies, in fact, I started my life as a IT services analyst, right?
Oh,
And I remember
really?
97, Infosys said by 2000, 40% of our revenue will come from a product. They used to have a product called Yantra or something, right? The reason Infosys did well as a stock is they junked that goal and did Y2K projects, right? And we awarded the company for growing at 40, 50, 100% during those years. So now when investors say, boss, you should have invested, I think you're being a bit two-faced, right? I mean, when the company was doing well, abandoning its product plans, we loved it, right? So I don't think it's so much the fault of the companies. I think, look, every large company becomes large in a macro context. There was a macro context from broadly from 1990 to 2020, which was free trade, relatively peaceful, defense expenditures were low, so fiscal deficits of government broadly were okay. There was unipolar world where US was the only superpower. So whoever you could crack the US market, like India did with IT services, China did with manufacturing, that was the macro context. And if you think about it, IT services gave us a lot of consuming power because of which FMCG, retail lending. So, a lot of our headline index is built around urban consumption. Because, in a way, private banks also are a play because 60-70% of the book is retail lending, right? And it's not very rural lending, it's a fairly urban centric kind of lending, right? So, the 1990 to 2020 macro landscape led to what our large cap index is. So my point of view is if you see US, the top 10 stocks in S&P 500 in US in 2000, only one has remained today, I think Microsoft. Everyone else has changed, all your G's and Exxon, whatever. For us, the creative destruction has not happened, right? Because I think 5 to 7 of our top 10 weights in Nifty are still there in the index. But I think next 10, 20 years look very, very different, right? Free trade's not there. It's not as peaceful. Fiscal deficits globally are stressed. There is a lot of innovation, tech, AI. So I do think that when see a lot of people when they ask small cap versus large cap, they go into what you said. Ki PE of small cap index is very high. This that that is important, but it's also important. I think you should be more open towards small caps if you think the economy and market composition is going to change. Because if new themes, new sectors emerge, it's typically start in the small cap space, right? So if you feel that creative destruction, that is the velocity of change of the index, is going to be high in next 10, 20 years versus last 20, 30 years, then you should actually favor small caps to my mind. And I do think in various ways, whether it's geopolitical, whether it's China plus one, whether it is, I think, almost necessary for India to become a manufacturing superpower because our services export base, first of all, is very high. Then it is getting disrupted to a certain extent by AI. It leads to regional inequality because only South and West do IT services and GCCs. For North and East to develop, you need to get manufacturing going. So, if you think about it, in the Nifty top 100, there are hardly any pure manufacturers. The only manufacturer are pharma and auto to a certain extent. But they have a front end brand which is supported by manufacturing. They are not pure manufacturing companies. Now, if the society is going to change where manufacturing becomes bigger and bigger part of the economy, then you will have to go into the small cap space to get the stocks which will follow that theme, right?
And also, it's there in the data, right? If you look at even the large caps across sectors that have reported numbers this time. I mean, I was just looking today, HUL has reported a 5% volume growth, right? Infosys, barely 2-3%. And why would I? And these are stocks that have not delivered also. So, why would I, as an investor, want to invest in a company that's doing 5-6% growth when there are a lot of small caps that are sort of on a high growth path? I guess
Yeah.
that's your argument.
Yeah, structurally. Now, tactically, I can see some case for large cap because I think the FI selling has been intense over last 2-3 years. The rupees got knocked out, so I think it's good value. And if the AI theme slows down for a year or two, which incrementally is my case, then we may see a lot of foreigner money come back. And given that large caps have underperformed, there might be a phase of large cap outperformance. But if you ask me on a 5-year basis, I still think a good small cap fund will outperform the large cap index.
So, in your small cap fund, right, I noticed that there are many sectors, very interesting themes and names. There's a large exposure that you have to the pharma space. And, I was just going through a lot of the stocks, whether it's Glenmark, Suvin, Wockhardt, Aurobindo, Kim, Strides, across spaces within pharma. Now, are you still structurally bullish on the pharma space after the rally that we've already seen? Or do you think that we are at the late stage of the pharma rally?
No, we like pharma both from a top-down perspective and also because it's a very rich landscape for stock picking. So first, let me cover the top-down, right? See, typically what happens when a economy grows from a very small base, there is low penetration of staples brand and staples do well, for example. But once you start crossing a certain threshold of income, incrementally 100 rupees, you spend more on healthcare than basics like staples or utilities, right? So, in general, healthcare grows at a rate which is higher than nominal GDP once a certain threshold of income is done.
Once the per capita
Yeah,
GDP
so
goes
we
up.
think we are crossing that stage. So, for example, we like MNC Pharma also because till $2-3 trillion, not too many people can afford an expensive cardiac or a diabetes medicine, right? But if you see China's history, for example, till 2003, the MNC brand were very small. But once it crossed a certain threshold, then these very high-end medicines take off almost like a hockey stick, right? So in general, we think healthcare is a sector which, for example, will grow faster than FMCG, I think, because it is more discretionary in one sense. The richer a country grows, more will be allocated to healthcare and wellness than staples. So the top-down thesis is it is a sector which is growing faster than nominal GDP, and B, it is a defensive sector where you don't have to worry too much about cycles, right? I mean, you can have a very discretionary sector like autos, but then there are big cycles within that. Healthcare is more stable, so that way it's also more peaceful to invest in.
Less stressful.
Yes. Now, bottom up, the thing is, let's say 10-15 years back, there were only US generics and domestic formulation. But now we have diagnostics, we have hospitals. So they're a very rich choice. The kind of innovation which we are seeing in contract research, in biosimilars, it also gives you a lot of, I think, opportunity to work hard and generate ideas, right? Because it's not probably as relatively simple as a lot of consumer companies. It's a bit technical in some of these areas. And whatever is technical or hard is good for institutional investors, right? Because you can afford to spend on that research. So I think both from a top-down and bottom-up perspective, I think it's a very good sector to look at.
Before I go back to sectors, the one common criticism about a lot of funds that, grow rapidly is the size of the fund, right? Eventually at a particular size, it becomes hard to outperform as well. Is that a concern that you have?
So my thinking on this is evolved. I mean, 10 years back, me and a lot of us as a community used to think that size will become a problem. Funnily, that's not happened. And on hindsight, I think what happens is while size gives you or reduces the nimbleness to change the portfolio and move your portfolio, maybe indirectly there is also a benefit that when you have high AUM, your ability to invest in a good research team goes up. Which is why if you see the top three MCs haven't done very badly over 10 years, right? Although they were big even 10 years back. So I think if you see the size and experience levels of the top AMC teams, they're obviously much more experienced or bigger than a lot of PMS, small PMS, for example, right? So there is a counter to the size thing. So I'm not sure that size itself is a disadvantage. If you can build a team which is good, I think you can overcome that problem.
Now the size is what? About over 20,000 crores of the
The small
small
cap, we
cap
are
fund?
almost 30,000, 28 to
Oh,
30,000
it's
crores.
reached 30,000 crores.
Yeah.
Wow.
I don't have the exact fact sheet number, maybe.
No, that's fine. It's just all ballpark numbers that we're
Yes,
talking
yes,
about.
yes.
Got it.
No,
got
because
it.
I have to be very careful about compliance.
Yeah. Fair. Okay. So within the fund, so you said pharma is one space that you're structurally quite bullish on, both from a bottom up and top down approach. The other thing I've noticed is you have a lot of large and small banks. And banks is a theme across all your funds, I've noticed. But I have this bone to pick on HDFC Bank because I feel like most funds own it, but it's just a stock that has done nothing for investors over 5 years. And my question is, why do funds still own that? And I was
That's usually
checking.
the best time to own a stock, right? When it's done nothing for many years, isn't it?
But it's also, I mean, I don't know what is your threshold. Maybe younger investors don't have that patience level. But till what point do you realize that, okay, you know what, now the opportunity cost is too much to bear? Because even if you look at results, right, there's nothing spectacular in
To be
HDFC
fair,
Bank.
across our fund, I don't think we've been overweight till recently. But again, the point here is that without getting into single stock in particular, I think what's happened with private banks is two or three things. One is in terms of growth or asset quality, the advantage or the superior performance they displayed versus PSU banks, that has narrowed. So the derating of private banks has happened, let's say, versus PSU banks. Will we see a situation where PSU banks show slippage in asset quality, whereas private banks don't? That jury is still out. But at this point, if you see last 3-5 years, there's not been so much difference in growth and asset quality of private banks versus PSU banks or even the smaller banks, right? So, which is why you've seen that the valuation has converged. But I think most of the valuation convergence is done because today I think the big private banks are not different multiples versus a lot of NBFCs or a lot of smaller private banks, right? The second is, I know this is probably a funny way to look at it, but they look cheaper than utilities now. Now, when you see some of these power utilities, for the if you compare price to book versus return on equity versus growth, they seem better risk reward because they have similar price to book, they have better growth, better ROE. So don't even look at bank, private bank versus NBFC. Sometimes I feel they're cheap versus cement or utilities, right?
But even larger banks versus smaller banks, right? I mean, I was looking at your small cap fund, the banks that you have, whether it's South Indian Bank, whether it's Karnataka Bank, DCB Bank. Some of these, like South Indian Bank, have had a phenomenal run, right? So when I compare like a large bank like HDFC Bank and a really small bank like much relatively smaller, I mean, it's just opportunity cost for me. Is that a very layman way of looking at it, or?
Yeah, maybe if you held HDFC Bank for 5 years, but if you go back 1 year in small cap fund, we didn't have big private banks, right? So while one doesn't want to praise oneself too much, but if you see the acquisition cost of a lot of these small banks and NBFCs, you will see that we've typically bought them at 0.5, 0.7 time book. We've not paid more than book for smaller um, private banks or smaller banks in general, or these NBFCs, right? Maybe NBFC is 1.1 time book. So we've tried to be pretty disciplined when we buy them. So as I said, we bought these large private banks when they look good, not only versus financials, but they look cheap versus a lot of other sectors like utilities and cement. So
But is
that's
that
a
your...
weird comparison, I know,
It is.
but I do look at it like that.
But is that your base criteria, most important criteria, valuations, or do you even
No,
juxtapose
so a
growth
lot
with
of
it?
people look at our portfolio PE, which is materially less than small cap index PE, and they think we are deliberately being value. Actually, it's not. So we have internet platform companies, we have metals when they're loss making. So as I said, the single thought process for us has to be that in 3 to 4 years, as a function of either earnings growth or P multiple, let's say coming back to long term mean or whatever thesis you have, you need to be convinced that the stock will double in 3 to 4 years. So it could be a bank at 0.6 time book, or it could be an internet platform where right now it's loss making, but we kind of do a rough FY30 profit. And let's say at an exit multiple of 30p, it needs to make sense for us to hold it, because then on FY30 it should look like it will double by that time.
So this is these platform companies are, you've got, I think, Zomato in one of your
We
funds.
have Zomato, we have Paytm, we have InfoEdge.
Okay. So for some of these quick commerce companies, right? And this is a common argument that eventually it'll boil down to a winner takes all kind of market. How does that work? I mean, do you still just stick to the top two? Because if you look at, say, something like a Zomato or even a Swiggy for that matter, not been exceptional gains since, it's not been much actually since IPO.
Yeah, I mean, obviously very volatile in the sense that if you got in when they bought Blinkit, it's still been a great return. But last 1.5 year, it's not. But yeah, broadly, our bigger exposure is to the leader. We may have a bit to the number two because right now the food delivery is actually more than the market cap. So there's an imputed negative value on QC. But again, what is the path to profits there is not 100% clear. So our big exposure is to the leader who's actually executed brilliantly.
What's your threshold in terms of time? Like if you have a particular thesis that a stock will say hit profitability
Our
or...
entire processes, whether it's fund management or research, is centered around 3 years. But we give weights to, let's say, for fund management, to 1, 2, 3, 4, 5 different weights, because base effect also matters sometimes. So if you started pre-COVID, post-COVID, those 3 months performance looks very different. But the weights are such that our sweet spot is 3 years. I genuinely feel that in this current world, fundamental investing you can't do below 1 year. And honestly, beyond 5 years, no one knows what macro context will Fed be at 0 or 10, God knows. I mean, you can't project beyond 5 years. For all you know, we all might be cyborgs or AI.
Yeah.
We may have brain implants. Who knows? Well,
Yeah, who knew that you'd be sitting with? I mean, when ChatGPT was launched, honestly, I didn't think it would become so big. It would blow up so fast. So yeah, so you're saying 3 years is your threshold. So if a company doesn't perform in 3 years, you exit. Is that the way to look
not
at it?
really. So we can wait till 5 years. Sometimes it takes time. But let's say today, as I said, if you're looking at a company which is loss making, for example, we try to do profits 3 to 4 years down, impute a exit multiple, and see what can be the target price in 3 years. Now, if COVID comes in the second year, then you stretch your thesis to 4 or 5 years. But the thought process while entering is 3 years. Now, you keep calibrating. Is it because of macro is not playing out? Is it the company's management? And if you feel company's management not executing, you should exit whenever you made that decision. It doesn't matter whether it's 6 months or 3 years, right? But if it's macro, see, let's say you buy a cyclical stock like commercial vehicles, and then COVID happens after 2 years. Then you will say, okay, well, everything got deferred by 1 year, so let's hold on. So that's fine.
Okay. Coming to some individual sectors again, I notice insurance is a space that you're quite bullish on. You have plenty of stocks there in the small
We're
cap.
suffering right now a bit, but yes.
Yeah,
That's why it's a big position, right?
I was going to come to that. So, as something like you have ICICI Lombard, there's Star Health, which is down 30%, I think, in the last 4-5 years. I don't know when
Yeah.
you guys entered, but there's GIC. So, when you say suffering, right now, if you look at, I was recently on a panel with the Insurance Council. And they were talking about how India is still so underpenetrated, both in health, life insurance, right? There are a lot of issues. There is mis-selling on one hand, there is trust issues on the other hand, lack of awareness. But this was the case even 10 years ago. Yeah. So something is not working in that space. But then what's your thesis here?
So you should look at general and life very differently. So general insurance, we think too much capital entered that industry. So one good metric for creating long-term value is when an entire industry's return on equity, weighted average, let's say, is below cost of equity. I think usually it's a good value investment, and then you buy the leader. Usually, industry's weighted average return on equity goes above cost of equity. The logic being that if 60% of industry is loss making or making 2% return on equity, at some point, whoever's funding those companies will stop funding, right? Similar to QC, let's say, right? And then if the leader usually has more resources, best people, and we saw this with telecom, for example, right? You remember Bharti at 250, 300, flatlined for years while Jio came, those 2G guys came. But if you held on at that point of time, then once the consolidation happened, the industry return on equity went up, you got a multi-bagger, right? Now, the challenge is the timing, right? You never know when these weaker guys go out. But which is why we also like these granular portfolios. It allows us to take these moonshots, as we call it, right? Something
Binary.
big may happen, right?
Yeah, or not.
Or not. But at least if you're losing, lose small, right?
Binary events, yeah. I mean, but do you take a lot of these moonshots?
Lot. Which is actually our small cap fund is entirely moonshot. As I said, we have to feel this stock will double in 3 to 4 years. Otherwise, we will never own a FMCG 50p company growing at 10%. We'll never own it.
But that's not an easy call to take, I guess, because it's like either very hit
That's
and
more
miss.
fun.
Yeah, 100%. I
So coming back to
gambling in
insurance.
a casino is more fun than anything else, right?
This is not gambling.
No,
We
no,
work
I'm just joking.
We work a lot. We go through a lot of anxiety. I mean, holding, let's say, insurance stocks,
Yeah.
being stressful, but we keep questioning ourselves. So general insurance, I think, is where hopefully telecom was maybe 7-8 years back when the Geo and all 2G things happened. Life insurance is a different ball game. I think if I take last 10-15 years, there's obviously been a lot of issues about customer satisfaction, mis-selling, whatever. But again, I think now we've come to the point where a lot of the things have been cleaned up by regulation. If you do reverse cash flow analysis, what is being built into the stocks. In fact, I think in one insurance stock, perpetual degrowth is built. As it's around embedded value or below that or something like that. So we feel like while I think it's still a sector where the customer satisfaction is not 100%, but 90% of the mess has been cleaned out in terms of mis-selling, I would think. And today look, again, just going back to that thesis that ideally we should be in sectors which grow faster than nominal GDP. So you have to think if someone who was earning 5 lakh per annum now is earning 10 lakh, where is that incremental 100 rupees going? Typically goes to healthcare, wellness, insurance, right? So again, if you see globally, there are very big market cap companies in insurance because as economies grow, people dedicate more and more money to protection. So there's no problem of long-term demand. It's a very oligopolistic industry, right? That also is very important. See, agriculture is great industry by size. The TAM is very big. But if an industry is not consolidated, you will never make money in a stock. So a lot of people get confused between GDP growth and stocks because of this. They think if a country does well, I mean, China's been doing well for years, but the stock market hasn't gone anywhere. I think stocks do well when there is industry consolidation, not necessarily. I mean, GDP growth is important, but as important as GDP growth is, are the industries consolidated or not? Because profit pools get created by consolidation. So the good part about insurance is, at least in life, I don't think there can be too many new entrants given the capital requirements. General, there have been too many new entrants, or the PSUs have been very aggressive on pricing. But I think the solvency ratio of the PSUs is below regulatory norm for most of them. If you see the marginal players like ACO, Future Generali, IFCO Tokyo, their profitability also is not great. So maybe about 50% of the industry is at very low solvency or very low profitability, which is, as I said, that's usually a good time to value hunt in one sense, right?
Hmm. Yeah, interesting. So your overarching theme, I reckon, and also maybe this is the reason why you have home finance companies also on your list, is that your expectation as India moves to 2,000, 3,000 per capita GDP or higher, more the disposable income for people will go up, and then that incremental money will be spent on things like health, wellness, insurance, home finance. But the fly in the ointment is the disposable income, right? Because now the very question about job creation is at risk, right? And we're seeing it everywhere. I mean, India needs to generate what, 10 million jobs per year, and these are non-agri formal jobs, right? And there is a huge unemployment issue that India is facing. So how does that tie in with your thesis?
So as I said, we actually think manufacturing has to pick up because of this imperative of India to move people from agri, where they are underemployed, to manufacturing. Look, but you can't be too top down in terms of investing, in the sense that we will have to calibrate our portfolio with, see, we think it should happen. It may take 5 years, it may take 20 years. So you can't bet. See, a lot of people are bullish on manufacturing, but I think you should not pay more than 20, 25 price to earning multiple for manufacturing, right? Because see, you have to remember that unlike services, manufacturing cannot be as high return on equity, right? Because you need working capital, you need capital expenditure. So just because I love manufacturing, I am not in favor of going and buying 40, 50 PE stocks. But yes, from a long term top down construct, we have to obviously be very focused on manufacturing, see if there's some good opportunities coming there, because see, policy support follows what society needs, right? So we do think that there will be policy support for manufacturing, because if a society needs to build the next export engine after services, if a society needs to build a sector which can absorb this underemployment which is there, if a society needs to even out equality, right? See, the thing about services exports is also that it is very unequal, because one offshore software engineer bills about 40-50,000 dollars, which is much higher than our per capita GDP, right? So you need, and even if you see regionally, South and West have dominated IT services and global capability centers. So at some point, if you want North and East, which have 70% of population, to develop, I think policy support for manufacturing will come. But just because of the top-down construct, I'm not, in favor of paying a lot of very high valuation multiple.
Mm-hmm. Now, keeping your stock market, sort of wisdom aside for a minute, you said policy support is required for manufacturing, and that is what will help generate more jobs. What else do you think is needed to, get the systems back in place? Because there are a lot of pieces which are sort of, broken, whether it is the jobs issue, whether it is income inequality, whether it is high cost of living, inflation,
Yeah, I think we
education.
need a holistic approach to. Okay, let me put it this way, right? We are very free market, I think, versus China, right? But we have to recognize that you can't compete with someone who has a very strong market intervention model with a free market model. We need to, like today, a lot of basic chemicals, steel, we are not able to produce versus Chinese prices, because we need a return on equity of 15-20%. Now, China is producing something probably at 0% or 2% return on equity and then exporting it. So, there are 2-3 things. One is we need to get our cost base down. So, like, I feel one of the important things government should do is, at least in top 10, 15 cities, just sell surplus PSU land to get real estate prices down, right? Because we need to get our factor of production cost down, whether it's land, labor, infrastructure, whatever, right? So one is we need to work on our cost base. Two is on currency, and this is probably debatable, but when you go back, China in 90s ran a deliberately um, undervalued currency. And even today, you could argue the yuan is very undervalued, right? Because it has the highest trade surplus. it has the lowest inflation. So it should ideally be maybe 6 or 5 as a dollar and not 6 point, oh, 7 point, whatever, 7.6 or whatever. So it could be one of the things government should think of is to run a very undervalued currency. It's a debatable topic because democracy, there is an inflation also which is a factor. But I do think there is a case to be made for a undervalued currency actively managed. Um, and third is obviously sector specific, which PLI and all they are there, but maybe the scale needs to go up.
Interesting. So, I mean, do you get a sense that work is happening on that front? First, I mean, you spoke about different things, but on manufacturing, and we all know, right, manufacturing as a percentage of GDP has stayed the same for the last 10 years. So, is there work happening, or is this just a hope against hope?
Look, I think obviously things move faster in a democracy in crisis. So we will see. I think as the currency, for example, has taken a knock over last 1 year. I'm sure there is some things that have happened, but yes, I think we need to up our game and have much more stronger measures.
Hmm. Interesting. Okay, so I just wanted to come back to this whole, and before we started the podcast, we were discussing what's happening globally with AI, right? The whole AI trade is sort of unraveling in front of our eyes. The high debt that these companies have taken, the default risk that credit default risk that these companies are facing. How are you reading into the situation right now? And from an Indian investor POV, how should we look at it?
No, I am also concerned at global markets. See, first of all, I have a simple metric to see the valuation of a market, which is basically look at last 10 or 20 years, what is the real return that has been generated? Because empirically, it's been proven that long-term equity markets can't generate more than 5 to 7% real return. They always converge back to that metric, right? So real return is above inflation. So if you see US, there is this funda of Siegel constant, which is Professor Siegel coined as 6.7%. So whenever you take 20, 30, 50 years, the real return always converges to 6.7%. So if you see, first of all, today I think S&P 500 on 10 years 13% inflation of 2 to 4%. It means it is, first of all, looking overvalued, right? 10% real almost. Second is the amount of capex that has happened, which is almost $1 trillion per year, is big by when you compare what happened in railroads or the dot-com boom where telecom infra happened. It is roughly, I think, 2.5-3% GDP. By historical US 30 trillion GDP, 1 trillion capex. By historical standard, for one sector to do so much capex, it is a very high bar. And obviously, you can't typically sustain this for more than 1-2 years, right? Now, third is suddenly what has also happened is you're seeing open source models come and give a big fight to the OpenAIs and Anthropics, right? So you might have read that Moonshot, which is Chinese company's Kimi model, is apparently now ranked close to Claude in terms of coding, right? Came out of the blue, right? And they charge much less for APIs or whatever. So the whole monetization of this capex now is under a cloud. Fourthly, you have a lot of circular financing structures, which always don't smell nice, right? So NVIDIA puts money in OpenAI contracts compute with Oracle. So there are all kinds of things that are
like
happening.
Like a khichdi happening there.
Yeah, but there's a lot of opaqueness about what is actual revenue, right? So given all this, and also, as you rightly pointed out, ultimately, there is a market action which is now becoming serious. That if you see one of the smaller, what we call neo-cloud, CoreWeave, their CDS spread is, I was seeing, is higher than Goldman in 2008. So there are serious debt issues being raised about the hyperscaler capex. So I think you have to worry because it's a large capex which is now coming under question. Now, the mitigating factor is a lot of this capex done by very good balance sheets. So Google or Meta or Microsoft, they can afford to take a bit of knock on this capex, but there'll always be peripheral players who
Casualties.
might have
Casualties, I called it.
slightly trickier balance sheets. So there are two parts to this. One is, do we get a credit event, just like Lehman, for example? I think that looks lower probability because the only candidate big enough for that is Oracle. And I was seeing the credit spread of Oracle still not reached a level where you worry about it too much, unlike, let's say, CoreWeave, for example. Uh, but the second part is, does a slowdown in this capex drive a global slowdown or a US recession? I think that is not a small probability, because if you see entire world, this last 2 years growth has been more capex driven than consumption driven. The retail sales, whether it's US, Europe, they've not been great. It's capex driven. Now capex has 3-4 legs. One is AI, one is defense, one is reshoring and all that. But AI is a big part of that. So if that slows down, we should be open to the fact that global economy will slow down or US may have a mild recession. We can't rule that out.
Can't rule that out. Okay, so that is the concern that you're watching out for. Okay, how does, and I notice, I mean, coming back to this IT services, debate, and people are on extreme sides of the fence now, right? I notice in your flexi cap you have Infosys as well, and this is stock that is lost 40-50% in 6 months. So it's a real concern. But what side of the fence are you on? Where do you see IT services 5 years from now?
I don't have a 5-year view. And I've gone on record saying, this is not a world to take 5-year views. I will not be underweight IT. Now, whether equal weight or overweight is depending on the day, maybe. But I also see, apart from everything else, you can call it a technical factor, that if this AI set of stocks correct, I think it will be positive for IT services from two sides. One is the narrative that AI build out is happening very rapidly and it will cannibalize IT services. That narrative gets softened. And there's a technical angle that from what I gather, there are a lot of funds which have a global tech mandate. So they can't invest outside tech, or even global funds which have a tech sector exposure where they want to rotate within that sector. And I think what will happen is, so much of tech is affected by AI that if you become negative on AI, I think a lot of these funds will have to buy IT services. Because just imagine you're running a tech fund, right? Your Max 7 is dependent on AI, your Microsoft, Google, Alphabet. Then you have the semiconductor complex, which is even more dependent on AI, the NVIDIA, the SKNX, Samsung. Imagine that you're negative on AI, right? I mean, you will feel all these stocks will lose 40-50%. And the only hiding place you have is to go into Accenture and Infosys and hope they don't lose 30-40 from it. It's a relative trade, isn't it?
But they should
I
also
believe there's
have,
fair amount of money which does this, right?
but they should also have that earning potential, no, which they don't have at the
No,
moment.
but at some points you go into a stock just to protect capital, right? And then you feel the herd will anyway come. So then, I mean, if you see, I think IT
So if you're
stocks.
going into Infosys for capital preservation, then I am sure there are many other
No,
avenues.
but life is relative for a benchmark investor. I think we underestimate that point. But if you see from bottom, they've already done 20-25%. It's not a small return, right?
Yeah, that's true.
And imagine that if someone switched from SK Hynix to Infosys about 2 months back, they will be 60% plus, I think. SK Hynix will be down 30-40, Infosys will be up 20%. There will be a star in that tech fund, right?
So if you had to just take a wild guess, I mean, 6 months back, if somebody would have said silver will be down 40% by July, no one would have believed it. 1 year back, if people would have said global markets will unravel, no one would have believed it, right? If you had to take a wild guess over the next 1 year, okay, which will be the sector you think of the moment, hot sector?
Cash? I was just joking. No, you're saying globally or in India?
Any, like, just overall, blank slate.
I think India financials. See, I don't know 2 years, but I think
Don't
next
say
1 year.
HDFC Bank.
Look, I don't know, get into stocks, but I just feel, I actually told this to someone. Look, imagine you are a global asset allocator sitting in New York, London, Singapore, wherever, right? What looks attractive to you? Your S&P 500, as I said, on 10-20 year basis, 10% real return, With AI, it's so dominated by AI. So if you're negative on AI, what asset can you invest in, right? So you
Not
got,
negative, but if you feel like AI is done, it's bit.
I then see the
Yeah.
technology will obviously do well. It's like internet in
Correct,
2000,
correct,
right?
correct.
But let's say you
The
feel a
stocks
big
have priced it
correction is
in.
coming, yeah, in AI stocks. You got to invest in S&P 500. Emerging market funds, 20% Taiwan, 20% Korea, you can't invest. China, cheap, attractive, but we all know very black box, very political. Gold, silver, corrected from top, but 10-year return of gold is still 12, 13%, which is way above normal return. You can't invest in gold, silver. So just relatively, India looks okay. No, what the currency is already taken a knock. So if you're a foreigner, currency is important, right? The currency is already taken a knock. Stocks, at least Nifty 50, the stocks haven't done anything for 3, 4 years. It looks okay, relatively. I'm not saying that the earning growth is so spectacular that you need to jump, but it's almost like protecting capital, isn't it?
Yeah, yeah, fair. Okay, India financials, not bad. And before that, you said
May-
cash.
Maybe, maybe it's self-interest. Huh? Obviously, it's all biased toward what we own, but yes,
No, but financials, if you take a very wide gamut, then there's so much, right? There's
yeah,
insurance, there is
we like everything actually.
housing finance, the AMCs that you have a lot of them
Yes,
in your
yes.
portfolio. So wow, interesting. Okay, we just have about like few minutes left before we wind down, and it's really been a fun conversation. But you told me your daughters will watch this show only if it's very entertaining. So so we'll keep the last part entertaining for them. Hopefully they'll watch till the end. If you had to, and this generation is very interesting, right? We've seen the way this generation has come out, and they have shown their might when it comes to things like education, reform, etc. So they think very differently from all of the other generations. If you had to give them one piece of advice, what would it be?
Yeah, it's tough. I really thank God that I grew up 30, 40 years back because planning a career looks so difficult now, right? I mean, whether college degree makes sense, doesn't make sense. But I really think that you should have massive passion for whatever you do. I think that's the only thing that's going to make you prosper. Without that, I mean, unless you don't see a job as a job now, you will never succeed, I think. And that's a good part, I think. I mean, in one sense, we are all artists now. We can't do a job as a job because that AI will do, right? I mean, you need to bring something different, something almost philosophical and spiritual to the job, right? Otherwise, see, the good part is I'm not thinking of AI as a very dystopian future because end of the day, if it can create abundance, see today a poor person's kid versus someone who's rich and who can go to very good tuition. I mean, the guys who get into elite university are obviously more likely to be richer than poorer, right? But if AI can teach a poor kid with as good a teacher, virtual teacher or whatever, it is a good thing that there will be better meritocracy in one sense in the world.
So kind of creates a level playing
It
field
does
across.
create a level playing field. What the downside is obviously because future is so uncertain, it's mentally very stressful. What jobs will get cannibalized or not. So I generally feel the youth should just do what they're passionate about. If it's lucky, it won't be cannibalized. But anyway, what you're just doing for routine stuff, it will get cannibalized, I guess.
But do you think education in its current form has become a bit
Yeah,
obsolete?
it is. It is. Because I think when you see, it started about 5, 10 years back where Coursera and all came, right? I mean, you could literally learn from Coursera whatever you learned going to Univ or whatever. But now it's even more accelerated because AI can package it much better. Which is what I'm saying that unless you're very passionate, you don't get something new to the table. So that is the most important thing.
So you are an alumni of IIT Madras, IIM Ahmedabad. So you've done the whole drill, right? And top notch. What is it that you've learned, and where do you see these institutions like go? I mean, 5, 6 years from now, because I mean, I have a young son, and it was always my aspiration for him to get into IIT. And but now, when I look at the way things are shaping up, the way AI is progressing, I'm just rethinking all these.
I'm a bad example because I think I wasted those years in the sense that look, I'm not. I didn't do too badly academically, but I really was lost in IT at least because uh, when I landed up there, I realized I was not interested in engineering. So those 4 years were the best years of life from a fun perspective. But have I ever used technically what I learned there was almost zilch, right? But I think all high branded universities have a role in the sense that it's just a filtering tool to my mind. What you learn there is not very important, but two things happen. One is um, people perceive that anyone who's come from that school has a certain quality. And more importantly, the people you meet there, that ecosystem, it happens for all colleges. Maybe you build an ecosystem, but there people do push each other, not so much only academically, but a lot of extracurricular activities, a lot of softer skills. So what I've carried is more the people relationships than anything that I learned there actually.
Oh, it's very candid, I must say. Saying you didn't learn much from IIT. I'm sure you spent a lot of years like working hard to get there because it's
2 years,
not easy.
no? Till 10th I was loitering. Then 11th, 12th I slogged. I really slogged. And that was because my brother went to IIT, so there was a lot of family backing. You have to do something in life.
But is it a privilege that was it like a ticket to everything you got ahead in life?
Maybe on hindsight, but at that point, the only ticket was just go away from home and live in a hostel because I saw my brother enjoying so much in the hostel that I wanted to just leave home.
You have your priorities right, by the way. Wow, okay,
Hostel life
interesting.
is amazing.
Yeah.
I keep telling kids you should never do undergrad at home. Never do undergrad.
Really? I agree completely. I never got a chance. I was always home. But I think you need to move out.
That's the age where a lot of your relationships or a lot of your values get built, right? And it's good fun.
So, in your 30-year journey, over 30 years maybe, what has been like, the most telling part of your journey? Something that always stays with you?
That's a tough one. I mean, how can you compress 30 years into one sentence? Uh, yeah, but I guess a lot of people, including my kids, tell me that I've been very lucky to find something which I would have done free. As Warren Buffett said, I would have done this free. It's funny people pay me to do this. I don't see too many people, at least the younger generation, having that mindset.
Do you think it's just luck or is it a lot of other factors? I'm
I think
asking
it's
you
luck.
this because.
No, it's luck. Also, I mean, obviously, I think it's important that you, like when I went for my engineering college at IT, the second year summer, I went to I was in Hyderabad. I went to an institute which was teaching stock market investing. So I had that hunger to learn about stock market, but eventually ending up in the stock market is also a bit of luck, right? It's not very easy in one sense.
And any mentors along the way who kind of helped you, handheld you?
Many. Actually, again, I feel very privileged. So I started my investing career with Prime Securities. I don't know if you remember. It used to be a
Of course,
very
yeah.
storied firm in late 90s.
Yeah.
And we had a team which did spectacularly well. There's Kaushik Shekhar, Amit Rajpal, Hari. So I got mentored by a lot of these guys who became successful investors themselves. And then I worked with two very contradictory bosses. I think which gives me a lot of balance, right? So one was Ashish Kachulia, who was a very momentum-driven guy.
You worked with Ashish?
Yeah,
Oh,
Ashish was
wow.
my boss in Prime Securities. Then I worked with him in his firm.
Oh, wow.
And then I worked with Naren, who was so contrary and so value. Almost like mirror images. But it's good to work with different investment style gurus in one sense.
So, what was your big learning from Ashish? I mean, he's like this, mysterious. No one can get a hold of him. No one knows how he looks.
And the single line I remember from his my tenure with him was, "Asli paisa bubble mein hi banta hai." So if you don't play a bubble, you will never make big money. It's exactly contradictory to, let's say, Naren, right? Naren would never believe in a bubble, right? So it was quite interesting.
Wow. So, you got to learn from the best, so to say.
Yeah.
And Naren has, I think, in this streak, right? The last 3 times I've sat with him, whatever he has predicted has come true. He predicted that don't buy silver when everyone was buying it. He said, don't buy global
Maybe
markets.
apart from the small cap bearish call, right?
Apart, I don't
which is
remember
a
that one.
mixed performance, I
But I
would say.
remember in like September 2024, when I had just quit my job, I met him at one of the conferences. ICICI Pro had a conference that time, and I met him there. And that time he said that this is the start of a downfall in the market. I think he got really bad, like he got a lot of flack for that. I think by December is when people, started that clip kept playing, and then people were like, "Oh, why is he saying this?" And then from there the downfall actually began. So yeah, I mean it's so many lessons. So any book recommendations that you have?
A lot actually. So started life reading all Warren Buffett. Peter Lynn's been a big inspiration. In fact, I remember first day when I went for the job at Prime Securities, I was given 5 investment books, including Peter Lynch. So those have stayed. But I think over time, the kind of books Howard Marks has written, that has been more relevant to the markets we are living in rather than those buy and hold kind of views of Buffet. Also, this Alchemy of Finance by Soros, I remember because that gave a new perspective into a macro trader. And I love thinking about currencies and stuff. So that was interesting as well. Um, Recently been reading more history actually.
Oh,
Maybe
really?
because old age you become more philosophical. But you learn a lot from history. I mean, it gives you a sense of how fragile forecasting is, right? Because a lot of times in history, turning points have come without warning, or like if you go back to let's say that I think Battle of Panipat between Akbar and Hemu was winning, just a stray arrow killed him, and then the entire history of India changed, right? So it gives you a sense that
There's no point predicting.
don't be very rigid about your views because things can change. In fact, and I've said this a lot now, I don't really believe in buy and hold investing because price discovery is fast, and the future is more uncertain than it used to be with things like AI and stuff. It can evolve very very fast. So I've learned to be very nimble in my views. So you have to keep digesting data as it comes.
Is that your approach to life as well? I mean, in general, because I feel like a lot of people find it very hard to adapt, in different decades, at work, in life, the challenges that life throws at you, right?
Yeah, I'm fairly detached. I'm not fixated about a lot of stuff. Um, Sometimes my family gets frustrated with this, but
But it's good to be detached, right? I mean, no
sometimes
expectation, no disappointment.
that's a very defensive way of looking at it. It's the way I think about it is try to be blissful whatever happens externally, right?
That's not easy, though.
It's obviously not easy, but you try to be. You take everything with a view that of so many random things, this has also happened, and this too will pass. And that's one of my favorite sayings. Actually.
But for a lot of people in general, I think today's day and age, I see a lot of, I don't know if you notice it, I see a lot of negative emotions come out, right? Whether it's people frustrated with the way their careers are shaping up, with the way the government is shaping up, with the way things are going. Maybe it's also comparison and all of that. And in your industry more so, there's comparison on a daily basis, from your investors, from your peers. How do you deal with the stress of all of that?
I become too old to worry a lot about it. But I think that's one of the traits when I recruit or interview fund managers. I think this sense of detachment is one of the things I look for actually, because if you start getting worried on 1 month, 3 month performance, I don't think you'll ever be a good fundamental investor. Um, I'm not saying you always need to be contrarian, but you should have a sense that sometimes you could be very right in your process, but because of random stuff. So I'll give you my own example, right? I mean, I've been managing mutual fund money since 2012 Jan, right? And my worst calendar year till now has been 2020, because one of my top holdings, and there were 2 3 stocks like that, were all outdoor consumption linked, and when COVID happened, obviously they got hurt. Now you can blame yourself a lot, but I think you should have some sense that the process was right, and you should not go into a negative loop about that performance, because then you lose the ability to take risk next time, right? I mean, To have 5% in a stock which halves in 3 months can be unnerving, right? I mean, but
And not your own money, public money, right?
yeah, and
Yeah.
this all those daily NAVs, and you see going from quartile 1 to quartile 3 in 2 3 months just because of COVID, which no one told you that being outdoor is a risk. I mean, we say leverage balance sheet is a risk. That's what you are taught in school, right? But no one told us that going outdoor was a risk.
Yeah. Unknown, as it is called, right?
Yeah, so you sometimes you will get hit by unknown unknowns, and you should have the mental stability or whatever to take that on your chin and get up and fight again, right? But that fortitude, I think, is important. That you are wrong for the right reason, in the sense you are right, but because of a random event, and then if you go into a defensive shell, that's the worst thing you can do.
So, how do you build that fortitude? How have you done it for yourself?
This can come to a cliche, but a lot of it is linked to spirituality, right? I mean, you have to maybe the way I see life is, and this again happens over time. This was not true 10 years back, but over time, you feel that there is a bigger power apart from you which is driving things, and our job is to have passion and give it the best. There is no guarantee that by giving our best we will prosper in life. I mean, again, just going back to IIT I mean, I've seen so many batchmates who in college I thought these guys will be the stars of our world, right? And then they've not actually done well externally. I mean, they might have done very well internally in their lives, but the guys who looked very mediocre have done very well. So you treat life with a bit of randomness.
Wow. Okay,
No,
I'm
so
gonna stay
so
with that.
I
I'm gonna stay with that. Whenever I feel bad
No,
for
I-
myself or extra good about anything I do, I'm gonna remember Manish told me once. You treat life with a bit of randomness.
the real journey is the inward journey. The external journey is something which happens randomly, I think. I didn't want to become so philosophical, but you drove me to it.
No, but I think, all the guests on my show eventually become philosophical. I think it's just something about making lots of money for yourself.
That is a myth, but
For
let
yourself.
it pass.
When you make a lot of money, then you can start thinking about all these things. So, no, but I'm really happy for you. I'm happy for your journey. And, you've built so much wealth for shareholders, for stakeholders. It's your fiduciary responsibility and you've taken it up and you've done great. So, I continue to hope and pray that in whatever capacity, you continue to do great work.
Sure, thanks.
And thank you so much for being
Had
on the
fun
show.
doing this, actually.
Yeah, and I hope your daughters are proud of you
Yeah.
for making this slightly entertaining and
I
relatable.
hope so too, man. I need it.
Okay, thank you. Thank you
Thanks.
so much.
Thanks a lot.